Interest rates are rising in 2022. So what does that mean to the Olympia real estate market? We're going to talk about it in this video. Hey, this is Scott with eXp Realty. And if this is the first time to our channel, thank you for being here. Please do me a favor and hit that subscribe button down below. And while you're down there, tap that little bell icon so you can get notifications when we post a new video. And we help people just like you buy and sell homes in the Olympia area. We absolutely love what we do. So if you're thinking about buying or selling a home now or in the near future, do me a favor and give me a call, shoot me a text message, send me an email. We can even do a Zoom meeting. All of my information is in the link down below. And again, thanks for watching. Thanks for being here. And so in this video, we're going to talk about rising interest rates. The sky is falling. Everybody's freaking out because the interest rates are rising. And I just want to put it into perspective a little bit. And also at the end of this video, be sure and watch it to the end, because we're going to talk about a little strategy that you may not know about that can help you get a lower interest rate and not even have to pay for it, possibly. Okay, so stick around, watch that. But really, I just wanted to put things into perspective here a little bit. And just talk about interest rates over the last, since the 70s, basically. So in the 1970s, interest rates were hovering, between 7 and 9%. And they ended the 70s on a high note at 11.2%. Okay. And the 80s is when it got really bad. And we can all be thankful that we didn't buy a home in the 80s, or at least if we did, we refinanced. But in 1981, interest rates capped out at 18.63%. Good Lord, that's a lot of money. Imagine having a mortgage with at 18.63%. So that's where it was in the 80s. It kind of cooled off as the 80s went along and ended the 80s at around 10%. 90s started hovering around 10%, into the 90s, going down a little bit more, around 8%. The 2000s started around 8% and kind of fluctuated around there. And in the mid 2000s, 2005, we actually got into the 5% range, 5.9, the high fives, for the first time in decades. And then 2008 came along, and you all know what happened in 2008, the housing market crash and the bubble burst. And incidentally, this is a topic for another video, but what's going on now in the market is nothing like what happened in 2008. And all of the real estate, economists and everything, we don't predict the same thing to happen. We're not going to have that same type of housing market crash than we did. There's so many different factors going on now than there was back in 2008. And so, rest easy. We don't see a housing market crash in the near future. Of course, we never know. You can never tell 100%. These are all just speculations. We don't have a crystal ball. But things are not like they were in 2007, 2006, like they are now. So we certainly don't see a housing market crash. So there we go. The housing market crash in 2012, the Fed lowered the rate in an effort to kind of offset that. And we saw rates of below 5% for the first time. At 2012 until now, we've really been hovering around that 3 to 5%. As you can see by the graph here, we're nowhere near what we used to be. We're even at 5%. In fact, I get notifications on my phone today. I got a notification. We're sitting at, for a conventional loan, we're sitting at about 5.25 right now. Now, granted, I mean, there's people I'm sure that are watching this video that got into the 2% and the 3% range. Congratulations. Good for you. 5% is still not that bad. Probably talking another $200 to $300 a month house payment on a typical, $500,000 house. The average price in Olympia is $450,000. Well, actually, I think it's like $478 now. So yeah, you might be paying a couple $100 extra, but here's a little tip for you. There's a little ninja tip. You may not be aware that you can buy down that interest rate. Okay. And so I actually got this information from Chris Yakel from Guild Mortgage. He's a member of a Facebook group. And he gives the example. I'm going to put it up on the screen here. He gives the example of a $650,000 purchase, and interest rates have gone up. You can't afford the $650,000 home. So you ask the seller to lower the price $20,000 to $630,000. You follow me? So the seller's got a home listed at $650,000. A buyer's interested in the home, but interest rates have gone up. They can't afford it anymore. So they go and ask the seller to drop their price to $630,000. So drop it $20,000. A better scenario would be to ask that seller to pay down the rate. It's called a seller buy down. Okay. To ask that seller, instead of lowering the price by 20,000, ask that seller to buy down your rate. So in this example, he says we ask for a $6,000 seller buy down, which actually lowers the rate. So if you look on the screen here, the current list price was $650. One option would be to ask the seller to drop the price 20 grand down to $630. Another option, option 2 there, is to keep it at $650 and ask the seller to pay $6,000 down on your rate. It's called a seller buy down. So which one do you think the seller is going to like more? Lowering the price 20 grand or dropping or paying down the rate for $6,000, right? It's $14,000 savings for that seller. So what does that do to you? Your loan amount is on the seller buy down is still the same as it was if you were paying full list price. It's still $617, but you go from paying 5.5%, in essence, 5.499% on line 3 there at interest rate. You go from paying 5.499% to 5 1/8, 5.125%. Okay. So $6,000 will buy that rate, and buying down that rate is for the entirety of the loan, entirety of the 30-year loan. So you can see what that does to your payment. It lowers it a little bit, nothing substantial, but your monthly savings is going to be $144. Okay. And if you look at what that does over the long term, even in a 5-year loan, a six at the very bottom line there, a 60-month saving is going to save you, the buyer, $12,000. So would you now, and if that seller doesn't agree to pay down that $6,000, the question I have for you is, would you be willing to pay $6,000 down yourself to save that $12,000 over the next 5 years? Because it's not just over the 5 years. Imagine how much money you would save over the life of the loan. And so seller buy down, or buying down your interest rate, is an absolute option for you. So it's something that you can look down to. And again, I want to say thank you to Chris Yakel from Guild Mortgage for posting this. I thought it was a phenomenal idea, and it just gives us as real estate professionals, and you as a buyer, or even you as a seller, just some additional ammunition that you can use. So it pays to learn about the real estate market and know what's going on. It pays to work with professionals. So hope you found that somewhat helpful. Again, my name's Scott with eXp Realty. Thanks for stopping by our page. Be sure and subscribe, be sure and like, and leave me a comment if there's something you want me to talk about, any questions you might have on the real estate, in the real estate world. Be sure and leave me a comment down below. And thanks for watching. We'll talk to you on the next video. Bye-bye.